Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor. Really pleased to have an old friend, one of our favorite guests, Michael Oliver, with me once again. And it's olivermsa.com to go to sign up for Michael's letter. I highly recommend you do so. Very reasonably priced service. And if you're a serious investor, it's one of those newsletters I think that you can't afford to miss. It certainly is my favorite, and I like to say, and heard it said anyway, that it is Michael's a favorite technical analyst of Eric Sprott. And I would add my name to that list. I know it was a long list, actually, of people, because Michael is, as I say, probably the most favorite guest that we've had on this show, certainly at the top of the list. Michael, thank you so much for joining me again.
Good to be back, Jay.
Always good to have you. I'd like to start out with the bond markets, the debt markets. We're in big trouble. The whole Western world is in a hurt right now. We lived beyond our means for so many decades, and now it's starting to catch up with us. And I think even the wildest Keynesians are starting to think that maybe there's something they can't overcome with more money printing. And they keep trying and trying and trying, but it doesn't seem to be getting us anywhere except deeper into the ditch. Well, what is your picture? I noticed that we've seen a decline in the 10-year rates. I think you pay a lot of attention to the 20 to 30-year rates. What is your outlook for the bond market? I believe, if I have understood you, you're short-term bearish, but you're short-term bullish, perhaps. Longer-term bearish. And that makes a lot of sense to me, because all I can see is debasement of currency as far as the eye can see. Debasement of currency, you don't want to own debt in that currency. So just let us know, what are your technicals saying? What is your view on the long-term debt market?
Our long-term analysis of T-bond futures, we look at 30-year bond futures, been around for decades. Okay. We turned major negative in October 2020. Okay. And bonds then were 170 in price, a little over there actually. They dropped by 2022 down to near 100. Okay, so they had a big collapse, meaning a huge rise in yields. Okay.
Right.
But since then, you could draw a line. If you get a yield chart, which would be upside, or price chart downside, you can draw a line from October of 2020 and draw a line across the chart. We haven't moved much. In other words, if it's a base in price, it's had its opportunities, and it's had numerous 2 or 3 rallies efforts to get up out of the muck. Okay. And it gets up into the 120s on T-bond futures, and they puke it right back down to 110 again. It just can't seem to get itself going. There's been 2 major efforts. This, I think, is the 3rd effort to get up out of here. I don't really think it's going to get really up out of here, so to speak, in a way that sustains. But I think you could get what we call a major counter trend rally, meaning while the long-term metrics look negative, technical metrics, you could get a counter trend rally against that is like maybe last 3, 4, 5 months, that kind of thing. And it would turn heads. People, oh boy, I got to buy bonds. Bonds have not been the alternative to the stock market that they have been in prior bear moves in the stock market. So, for example, in the drop we had from January to April in the S&P, if you look what happened at the end of April for the bonds, they puked. They dropped in 2 days from like 121 down to 111, like boom. Like that's a crash. So T-bonds weren't behaving opposite to the stock market. So large portfolio managers who might be skeptical of and want to move, 2, 3, 4, 5% out of the stock market into something they used to perceive as safer have been reluctant. It's not worked. But I think it might work now. And we've already crossed through some numbers this month that, that are fairly far below where you are right now, that suggest, no, we've sort of broken out and we're going to get some kind of rally. From an investment point of view, I think the rally is a non-event. From a trading point of view, you want to trade? Fine. There's probably a trade here. Buy T-bond futures, buy TLT, scoop out some money over the next several months as it goes up, and probably this stock market goes down. So finally, maybe the bonds act inverse to the stock market. Finally, But the ongoing alternative is always, monetary metals. So, focus there.
So why do you think, Michael, it's behaving differently now? You think those money managers are starting to doubt the
Yeah,
veracity of the dollar. They're
yeah.
they're starting to understand really what's going on, that fundamentally our markets are, the dollar is cooked, essentially, that it's in
Yeah.
trouble.
The
And
dollar is, we got bearish over 104 back in March. It's right now trading in the 96s dollar index,
yeah,
which is nothing but the dollar compared to three other pieces of,
yeah.
worthless paper. But still, it's in a bear trend,
Hmm.
and that will upset many norms and expectations. Uh, But yeah, I think what's going on, you're dead right. I think that the rally we've seen in bonds lately is not, oh, the Fed's going to cut rates. No, they cut rates back in last September. Okay, they started cutting rates,
Hmm.
and September a year ago. And if you look at what happened to T-bonds, then they puked, they collapsed, yields went up while they cut rates on the short end. So T-bonds said, we don't care about the short end of the market. So right now, if they cut rates a quarter point or whatever, it really, that's not what's affecting bonds. I think you're right. I think it is major long-term guys who've been in the stock market and know points of doubt.
Hmm.
And they're saying, hey, there's too much enthusiasm out here. We got too much leverage. I talk to my friends in the portfolio departments, and they tell me that they've never seen such individual investor leverage in the stock market,
Hmm.
margin, so forth. And they want to move to something that they've been taught, 60/40 rule. Okay, it's a good place to be. And I think that's what you've been seeing.
Hmm.
Simply that.
Yeah, well, certainly, maybe there's a lot of leverage in the stock market, but one thing that's taken place of late, I think almost at record levels, the insiders have been selling their shares.
Yeah.
These CEOs, they like to, buy their own shares back, get the stock up, and then dump their options, or
Yeah.
the options that they've earned over the years. Meantime, the retail people are going into the indexes, and the indexes buy the Mag 7. They buy a few select stocks, and the large number of shares of companies are not seeing new highs in shares. In fact, they're really not doing well at all. I don't have those numbers in
Yeah.
front of me, but the breadth of the market is not good, as you say. Michael, I thought that maybe I'm kind of giving up on the idea that we're going to have a bear market. It seems to me that they're going to keep the money flowing to keep the thing up. And it reminds me a little bit of what Alistair McLeod talked about in the past on my shows. Talked about the Mississippi bubble. And there, the idea with the Mississippi company, and the whole thing was buying shares of the Mississippi company. Well, how do they keep the Mississippi company, the share price up? They keep printing money. So the share price doesn't go down. The shares maybe hold up there for quite a while. But at the end of the day, the shares are worthless because they're denominated in the currency of France.
Yep.
And
Yep.
so I'm wondering if that may not be what's taking off. And that's the reason you're not seeing money coming out of we're not seeing the equity markets go down, which I thought would be very bullish normally under past cycles, would be very bullish for the bond markets and the United States. Of course, there's other things going on in the bond markets too. We don't have any longer foreign money flowing into the U.S. debt markets as much as we have. In fact, a lot of countries that are looking to get rid of dollars as fast as they can and get out of the dollar system because they were punished by the dollar system. Both Republican Democrats, weren't very kind to Mr. Putin when they didn't, basically this allowed him to trade internationally. And the rest of the BRICS, I think, have rallied behind him and they said, well, this isn't fair. This isn't right. You guys are stealing, confiscating our wealth. So we're going to find a different way, and you can take your dollar and, take a hike with it. So do you think that, what is your outlook on the equity market now?
We still think technically that we're in a we're not troublesome, languishing top and pattern. We think that late last year, early this year, S&P was, we're about 9% or 8% above it right now. Okay. I think that was part of the topping process. I think this is also momentum says no, do not trust price new high. Quite often it tops in the stock market. Whether you look at 2000, we turned bearish in January. That's the dot-com market of 2000. Well, heck, by August, they made a new high monthly close in the S&P. Okay. And it was enough to, for people to feel, oh, so comfortable, and it's going up forever because, it's been in a holding pattern now. It's just push to a new high close. It was all a trap.
Mhm.
It didn't work. In 2007, we predicted in 2006, the close of that year, that we'd go up into 7 and top. And the probable topping area would be 1550 to 1600.
Mhm.
And what we were saying then is we're going to go up and take out the price high we saw in 2000,
Mhm.
which was 1550.
Mhm.
So how could we predict a high, a top that's above the old high? That should be bullish, right? Okay. But
Yeah.
what happened in the spring of 2007, the S&P went up to 1550 again,
Uh-huh.
back to the 2000 high, and dropped into the summer. And so a lot of the price charters said, oh, look, a double top.
Yeah.
But then it started to turn up June, July, August, Sept. In September, the Fed cut rates. It was a surprise. It
Mhm.
was an ambush cut. It wasn't like the one we've already priced in and
Right.
anticipated.
Right.
They cut rates, and for the next 3 weeks into October of 2007, you went up to 1575.
Mm.
Okay, think about a price chart now.
Yeah.
1550 in 2000, 1550 in 2007 in the first half of that year, back off. Then you come up and you break through that high, those
Uh-huh.
dual highs. Isn't that bullish?
You would think
Right?
so,
Yeah.
normal.
Okay, that was the top.
Mhm.
Okay, period. If you sold that, you nailed the top. Okay.
Yeah, but a lot of
And
people were thinking that's bullish. It's time to.
oh, sure. Well, what are you doing now?
What were your momentum charts telling you then?
The momentum charts told us even in 2006, you're about to make the top, and we had a target zone, and it turned out we were dead right on the target zone. That it was, in fact, high enough target zone to where you took out the old high. And therefore, the point I'm trying to make is don't just look at the price charts.
Right. Well,
So we
that's
took out the January high. Oh boy. By the way, when you talk about the Mag 7, it's more like the Mag 3 now.
is it?
Okay.
Yeah.
The 3 or 4. It's not the 7 anymore that took out the old highs.
Mhm.
Okay. So you're even losing leadership there in the leadership area.
Uh-huh.
Okay.
Uh-huh.
So it's not what you think it is. And I think you're right. We're losing, participation in this. This is narrowed quite a bit. And I think that there's a good chance in the fourth quarter we're going to see downside damage. And I would not be looking so much at tech. I think it'll go down because
Mhm.
it'll lead the way down as well. Watch the financials.
Oh.
In particular, we're watching about 6 major banks, and we're watching the major credit card companies, Visa and MasterCard. They have momentum trend structures on them, meaning if you look at the momentum chart, you see what looks like a floor,
Mhm.
which was not broken in April, okay?
Mhm.
But it's been used so many times, and you're not far from it right now. So if you ooze down just a little bit between the now and start of the new quarter, you're going to be sitting on death's door again.
Mhm.
And it could be a fourth quarter event where suddenly you get an ambush in a sector you weren't looking at,
Mhm.
one that's too important, financial sector,
Mhm.
credit card debt. The banks won't like that either. So
Well,
we're still arguing that there could be a major bear. Now, you made a good point.
yeah.
Could we go to a Venezuelan market?
Yeah. Well, if the
Yeah.
banks are in trouble, that's when you can bet your bottom dollar or your bottom,
Oh, yeah, yeah.
let's say your bottom ounce of gold
Yeah.
that, that
Well, the Fed will respond to that. They
yeah,
don't care about Nvidia, but they care about the 6 big banks. Okay.
yeah, more than
Uh,
anything, more than
yeah.
anything. So I was listening to an Adam Taggart interview with Lacey Hunt recently, and Lacey is really bearish. He thinks this. He believes that the tariffs are going to do a lot of damage. That's, Trump is selling the idea that it's just a one-off and don't worry about it. But he believes that it's not inflationary. It's going to lead to a very significant downturn, that and other issues. And we're seeing a lot of weakness among the consumers. They're tapped out. There's a lot of reasons to be bearish on the equity market, but you wouldn't see that from the equity market. Equity market, everything seems to be going just honky dory, but underneath it, and the real economy isn't looking that great. So I'm just wondering if there might not be some support, but what you're saying is the support for the bond market is not likely to be there from the equity market decline this time because of people are catching on to the fact that the dollar
Mhm.
is not, I mean, I think somebody said a barrel of oil is a barrel of oil, an ounce of gold is an ounce of gold. What is the dollar? And you know, in McAvity, I think it was the late
Yeah, yeah.
McAvity. That was one of his favorite sayings. And people are starting to say, yeah, well, what is the dollar? You know, so all right, but so I know that the monetary metals is where you want to be. That's where I want to be. That's mostly where I am. What about some of the commodities? What about crude oil? You had something to say about crude oil in the last weekend that was kind of interesting. And then you questioned, well, what would that do to the mining stocks? Maybe you can comment on those two. First of all, how is crude oil looking to you technically? And then what is your idea? Because oil, energy is a big part of the mining business, and a lot of people think that when those commodities go up, it's sort of damaging to the profits of miners. Miners are making profits now. The gold miners, the established ones, making money hand over fist. It's just beautiful what they're doing now. Free cash flow is unbelievable. Record highs.
Well, as far as oil goes, it's very reflective in our technical analysis of the Bloomberg Commodity Index. So it's not just an isolated commodity. Grains look like they're going to reflect it as well. We had a major move from late 2020 in the Bloomberg and oil as well, from a disastrous low, a price low that is just ridiculous in terms of historic prices of these assets. The Bloomberg Commodity Index was down, trading in the 50s. Okay, back in 2008, it had a high at 237. So we turned up in late 2020. We called it, we predicted it'd be a commodity explosion. Bloomberg doubled. We got bullish at 70, so it was about 10 or so off the low, and it ran to 140. And it peaked weeks before the Ukraine-Russia war began. Which, remember, that was a war that was really debatable whether it was going to occur or not. Most analysts thought, nah, it's not going to happen. Yeah, it's going to happen. It really wasn't a certain thing. The market had gone up for a year and a half prior to that, oil and Bloomberg. Since then, they pulled back in late 2022, collapsed back down, and the Bloomberg dropped back under 100, meaning dropped 40 plus points, and went sideways. Oil collapsed from 130 and started to live in the 60, 70 zone.
Right.
And they've just gone dead. Whereas you look at their charts and you say, gee, nobody can make money there, up or down. It's just sleepy.
Yeah.
The momentum charts that we maintain long-term say you're bottoming. In fact, the Bloomberg right now traded up to over 105 yesterday. You close a month out above 106.5 by any credible amount, you're breaking out on momentum. And you're going to start a whole new leg. And oil has the same situation. It's trading 64 right now. You get into next quarter, certain of our numbers will shift because we do our 3-quarter average, what it is, and we oscillate price against that. You get up about 67, high 67, 68 next quarter. $4, no big deal. You're breaking out over massive momentum structures that say bull trend starting.
Wow.
Now, that would shock people. Because, Trump said, hey, I'm going to keep oil down and gasoline prices down. And so far, it's stayed sleepy. Most commodities have, actually. It's not just been oil. That would upset a lot of people and upset a lot of notions about, hey, nothing's working. Okay. And emotion then comes in. But you ask a question about the miners and the cost of production. Yes, it's a large factor. But if you go back historically and look at major bull trends like, the 2008 to 2011 highs surge in miners, and then again in 2011, and lay an oil chart underneath it, they're identical. They went up together. They both broke down together. They went up together. In other words, the rising oil was totally in sync with the rising gold miners. So, yeah, I have to fundamentally agree. Yeah, it probably impacted their profits to some extent, but there's bigger things at play here than nitpicking profit margins. There's far bigger global and macroeconomic events underway.
Well, that's true too. But if people really start to doubt the veracity of the currency, then the monetary metals can make up for whatever oil is doing. There could be a sort of a vicious circle there. Yeah. But so who knows? I mean, but the margins are just spectacular right now for gold miners at $3,700 gold. Okay, so I take it that you could see some profits to be made in the commodity sector, various commodities at times.
Yes.
Of course, you cover all of them in your newsletter. people get that newsletter, they'll know where, in fact, you do almost a monthly commodity, or you do a frequent
Yeah, it's a monthly report.
monthly commodity report that says where,
We just put one out yesterday, in fact, yeah.
with charts that show, and again, momentum is so important in your work, and you have proprietary momentum tools that you use that have been so effective, very helpful. So I believe we're in a gold bull market of my lifetime, and I'm not saying that necessarily in a gleeful way, because I think that underneath it is a lot of stress, a lot of turmoil, a lot of difficulty that society is facing, will face when the wheels come off the wagon. But gold and silver, gold, you have to have gold. Silver, though, silver and gold, you made a point in your letter, your weekend letter, that the gold silver ratio is probably the most important technical item that you're looking at now at this point in time. Could you explain why?
Yeah, what we do to measure silver gold, unlike what most people do, we divide 1 ounce of silver to 1 ounce of gold, express it as a percent. So right now, silver's traded at about 1.15% the price of gold. You go back 50 years, and we showed a graph of what was the highest reading each year of that silver divided into gold. Highest monthly close, okay? And 21 of those 50 years, it was at least 2%. Okay. That was almost a norm. In fact, it didn't in the bull market years, 78, 9, and 80, 2010 and 11, for example.
Yeah.
Silver was up 3.5 to 6% price of gold. Okay. But right now we're coming up off of a low that was just below 1%. And technically, when you examine the spread, which is effectively, it's a price chart. It's the price of silver, price of gold.
Sure.
And we also run momentum of that spread. We're starting to get breakouts. And over the last 5 months, for example, if you look at what silver's done versus gold, it's beat gold solidly. Okay. And I think that's the onset of a major shift where at minimum, silver's going to gush up to the 2% level again, which is, again, that's not even extraordinary. It's routine. Why aren't we there now? Now, also another comment I'd like to make is, where's gold versus 2011 high? Well, it was 1920, it's 3,700. Okay, no issue about the 2000. Where's copper, a base metal?
Yeah.
It's trading above its 2011 high. Okay, so is it outlandish to say that, hey, maybe markets have made a mistake? We know that historically. Markets get overdone. Markets get overdone on the downside, and they sit there and people say, oh, it's garbage. It's no good. And it's a mistake by a lot of investors. And finally, when reality hits, it wakes up in a way that jars everybody. Well, silver is one of those situations. And its spread is arguing it's ready to ramp again. Its price action is beginning to indicate that relative to gold. And it's up more in a year than gold is. Even just go back a full year, it's up more. And I think it's going to rampage over its old dual $50 highs, which are ridiculous old notions anyway. They're antique price highs.
Yeah.
And we're only up there for hours, by the way, not weeks or months. And I think with this next surge is going to carry us, this is not the top, by the way, into the 60s and 70s, the next surge. And I think that it could happen this year.
Wow.
So, and now that's not the end of it. Ultimately, it wouldn't shock me that gold goes to its normal high. And by the way, I hear this on CNBC, et cetera, like gold it's gone vertical and you should sell vertical and buy, gold is not even halfway up in dimension, percent gain. What we saw from 1976 to 1980, an 8-fold move, or from the 2000, 2001 lows to the 2011 high, an 8-fold move. Gold would have to be about $8,500 to just match the dimension, the ratio move of those two prior bull markets, which occurred under circumstances that are far less earth-shaking, globally dramatic than what we're facing right now.
Right.
So gold going to 8,000 would just be, I will say, oh, so what?
Yeah.
Okay.
Well, certainly in 2008, 2009, it was a pretty scary time. tons of money was pumped into the system, and gold took off 2011. But I guess one of the things I wanted to ask you, Michael, is how do we know when this bull market is over? How will we know when it's over? I think that we're in the early innings of a bull market, at least of this phase of this major bull market.
Yeah.
That started when do you say it started? About 2013 or so?
Well, the 2015, December 2015, gold was
15.
$1,045. Okay.
Right,
That
right,
was its bare low. Okay.
right.
So you've tripled and a half. Okay. Not eightfold. Okay. Uh, you ask about when does it end and where is it? I have a different view on that.
Mm-hmm.
I think that what we're facing in global financial markets, in global institutions, particularly financially related, like central banks, and the nature of money
Mm-hmm.
that's put out by government could change. I think so many things are going to change in the next year or so that you're not going to top gold, that it's going to level off and be institutionalized again as money.
Mm-hmm. Mm-hmm. Mm-hmm.
This government, that government. Finally, the US probably be the last one to do it, where suddenly it's a gold-backed currency.
Mm-hmm.
Uh, and it doesn't collapse again because we're back to a gold standard. We got off that with Roosevelt, and then Nixon helped.
Mm-hmm.
Uh, it's only been, 100 years that we've had the Fed, and about that we had Roosevelt, take everybody's gold from them. So it's not like it's forever that you have fiat currencies.
Mm-hmm.
They've been an experiment of one long human lifetime.
Mm-hmm.
And if it doesn't work well, and I think reality is going to demonstrate that, not just here, but elsewhere in the world,
Mm-hmm.
then the public is going to get upset. There's going to be emotion. Trends will be destabilized. And I don't mean Trump as a destabilizer. I mean, even he might be destabilized by the new forces, where we
God
go
knows. Yeah.
toward, real money again.
Yes.
And
Yes.
all gold is expressing over the eons, decades, is the ongoing decay in the real value of money.
Yep.
Your granddad built a house, cost $4,400.
Mm-hmm.
Today it's $450,000.
Mm-hmm.
Okay, it's because of the decay in the money unit. I don't mean dollar versus yen or euro. I'm talking dollars' real buying power.
Mm-hmm.
Gold simply expresses that. It inhales and it exhales, but it keeps up with that ongoing decay. And I think we're going to be institutionalized. Wouldn't surprise me. Silver as well.
Yeah.
After all, we've had silver standard, before.
Yeah, we've had it in the past. Well, so 8,500, if we just go to where we were in the last
Yeah.
cycle, and they managed to keep the system intact. Now you're talking about something that's sort of much different, as you say, a new monetary system. So it's hard to say where that number might be, but 8,500 is sort of a conservative estimate, and you might say, although it doesn't
It's
sound
done it
conservative.
twice. Yeah. And since being legal, it's done it twice.
Yeah.
Okay.
Right.
Keep that in mind. Okay.
Yeah,
Eightfold. Okay. Keep it in mind. If you're long gold, don't think this is a major move. It's not even half as much as those.
Well, there's going to be a redistribution of wealth as that happens, as the currency declines. The people that own the gold, the people that own the silver, the real stuff will come out ahead of those that are in debt and those that don't have any assets. That's the sad thing. And what we see, of course, is this redistribution of wealth that has occurred because of the monetary system, the fiat monetary system, and the lack of free markets that are based on the reality of people's what they produce and what they consume, instead of redistributing wealth. The government takes a big chunk of it, and we fight wars and we blow up people and overthrow countries. We do all kinds of things domestically. People are greasing their palms of the people that finance the campaigns of these shysters, and it's a mess. So if we get back to honest money, the reason that I got involved in gold, and I'm sure, Michael, I've told you this in the past, I had a professor, 1966, named Dr. Peyton Yoder. He was a history professor in this little college that I went to in Kansas. And he was convinced that when nations debase their currency, their work ethic declines and overall their morality declines. And I have to say, from that point of time, that really struck a chord with me. And I wasn't a particularly good student in those days. I played baseball, soccer, drink some beer. That was more important than studying. But that stuck somehow. And I started watching what was going on during 1966, 67, Vietnam War. How do we pay for it? Well, by golly, the United States has got to have those wars going. And so we've got to sacrifice, we've got to find a way. So Nixon took us off the gold standard so that we could print. But that day is coming to an end, I think I hear you saying, because the debt load is just, it cannot be financed. They're going to have to print money. They're destroying the civil order that we have. I think that all of the hostility that's going on has something to do with this redistribution of wealth, I think, and other issues too. But anyway, that's neither here nor there. Just like to wrap up with a couple of more ideas that came out in your last newsletter, the weekly one. The gold silver ratio we talked about, but the gold shares are now starting to beat the gold. That was another ratio that you showed.
Oh yeah, yeah.
And
They've broken out on their spread.
We've been waiting a long time for that. And then the one that I like best, Michael, because of the kind of junior mining companies that I follow in my newsletter, GDXJ has now overtaken, I think, slightly. It's broken through the GDX. So does that mean, well, I guess if you're more speculatively inclined, as I am in my newsletter, I buy the juniors, the guys that are finding the gold and the silver. So that's a higher risk, but higher reward potential. And you say silver is going to overtake gold. So I guess one might be rational, one might make a rational decision to weight their portfolio more in silver and silver shares than gold and gold shares.
Well, if we did a spread also of GDX versus, or SIL, the silver miners ETF versus GDX. GDX does contain about 10 silver miners, by the way, so it does have some in there. But SIL is breaking out on a spread basis versus GDX. And we're just looking at the spread chart. It's really pretty much matched GDX for the last couple of years. It's held par status. In other words, it dropped from its 2020 highs versus GDX more than GDX did, therefore it underperformed. But over the last couple of years, it's really sort of gone sideways versus GDX in terms of relative gain, et cetera. But it's broken out now. And it looks like it's the same assumption we're operating on with silver versus gold. I think silver is going to outpace gold rapidly. I think silver miners are now going to be the better place to be among the miners than the gold miners. Not that the gold miners will do bad, but I think the silver miners will now catch up because they're as underpriced as silver is. For instance, GDX is out above its 2011 high. XAU index out above its 2011 high. SIL is in the 60s. Its 2011 high was 90.
And
It's
where
go
does it
50.
now?
It's in the mid 60s right now. It could go up, nearly 50% just to get to it. So I think there's a lot of catch up that's going to occur. And my personal investments are more emphasized in silver miners, and I even do options.
Yeah, which you disclose. I think at least you disclose your silver, gold, your bias towards silver. You're pretty upfront about. I think you're very upfront about what you're doing personally, and I applaud you for that, Michael, for for letting people know. You're just really an observer, a student of the markets. One thing that I've always admired about you, and it's been very helpful to me, is the fact that you're non-emotional. Well, at least in your analysis, you are, and you keep it real. It's based on what the numbers are telling, what your work is telling you, and it's not something that you might want to see, but it is what it is, and that's what that sort of objective analysis is what I appreciate, and I think which makes you so valuable. Any closing thoughts about how people should prepare for the storms ahead? I guess.
Well, I think don't bemoan it. It's a reality that's going to happen. And just be on the right side of these markets. And by the way, let's assume you had a Venezuelan situation. You mentioned that a while ago where they print enough money, everything goes up. Okay. So it's meaningless, right? Okay. We showed that chart in a recent report and said, gee, we should all be in the Venezuelan stock market. It's just going vertical. Of course, the loaf of bread went vertical too down.
Yeah, exactly.
If they ever did that, and I don't think they're going to succeed, I think we're going to get the downside stocks here. But think about this. As I explained, gold reflects the ongoing decay in money. Okay, the real value of money. Go back 25 years, same time, same month, let's see, September of 2000, September now. Where was gold then? Where was the S&P then? Because everybody seems to think you just got to stay long that stock market. It just keeps going up.
Yeah, yeah.
S&P is up 3.5 times where it was then. Gold is up 11 times where it was then. Oh,
Yeah.
yeah, ups and downs. But frankly, even over the last 10, 15 years, gold has been par and better than the S&P. And yet nobody recognizes it. They're still all obsessed with this notion that the stock market goes up forever. Put your seatbelt on, guys.
Well, and even if it does go up nominally forever, if the purchasing power
It's a version of the
disintegrates,
Venezuelan stock market.
yeah,
Yeah.
I mean, the
Yeah.
Mississippi bubble is the one
Yeah.
Alistair liked to
Yeah.
talk about on my show in the past. So I think that's very good advice. And again, folks, it's olivermsa.com. It's the momentum and structural analysis. He has his own proprietary tools he's developed over the years, studied with some of the top technical analysts in his youth on Wall Street, and now he's putting it to work for lots of people. Very helpful to me, Michael, and I thank you once again for spending time with us. It's great to have you again. By the way, and enjoy your son as well when he comes on to talk about some of the individual stocks that he tracks. He's learning the trade from his father. I think that's beautiful. I would love to have had my son work with me at this stage of my life. It wasn't to be, I guess, but in any event, your son Brett is doing a great job. Ask him to come on the show today, but I guess he's over in Japan somewhere.
Vacation. Having a vacation.
Yeah, wonderful. Well, and he's a young man. He certainly should do it. Michael, thank you so much once again, and all the best to you and yours, and keep up the good work.
Thanks, Jay.
All right, that's it for this week, folks. Expecting to have Kirsten Brewer, that's Kirsten Brewer, the CEO of Hydrograph Clean Power, join me next week. Until then, goodbye and God's blessings to you.